Hello, this is Quandary Invest. Today I'll be talking about Nvidia stock. So as you can see over here, Nvidia stock is down around 16% year to date. It is down around 25% from its highs. So over here, it's down around 26% from its highs. So is it time for you to buy Nvidia stock right now? So Nvidia historically is trading at one of its lowest points in terms of valuation. It's currently trading at a 37 PE, and it is arguably growing much faster than it was back in 2019 when it was around 21 PE. So the valuation now is justified, but there is a few bear theses when it comes to owning Nvidia stock. So let's talk about the bull theses first. All the hyperscalers, you have your Google, your Amazon, Microsoft as well, all of them are increasing capex in 2025. And they exceeded their capex expectation in 2024 as well. So the capex cycle is still going up. We don't know when it will top, but in 2025 it is projected to go up as well. And so Nvidia will definitely be a great beneficiary of it, as all these companies, they build out all their data centers, they build out more infrastructure for AI. So if you're a long-term Nvidia bull and you think that this AI capex cycle can continue for many years to come, then I don't think it is a bad buy now. In fact, it is trading at a cheaper valuation than a lot of your Max 7 companies. Over here, it's 25 forward PE. That is cheaper than your Microsoft, Apple, Amazon as well as I believe Meta as well. So it's providing a decent buying opportunity if you think this AI capex cycle can continue for many years. But for me, I have my own concern. So my first concern is simply that the margins are declining. So you have competition in the form of your AMD chips. You have all your different hyperscalers coming out with their own chips as well, like Amazon, Microsoft, and Google. And over here, as you can see, the margins have been declining over the past few quarters. So gross margin has been declining from around a 78% to a 73%. 70% margin is incredible for a business, like any business in general. But for Nvidia, the problem is that their margins are declining, and so it could signal that there is more competition, meaning to say that they are trying to use prices to bring in more customers, which is what I don't like for my companies. And with this AI capex cycle, it is likely that your margins are extremely elevated, meaning to say they are much higher than usual. And so it is likely that all these margins will come down when this AI demand sort of fades away. So the next reason why I don't really like Nvidia is because they rely too heavily on this company called TSMC. So TSMC is a chip making company. Basically, they take Nvidia's designs and then they make the chips, and then they give it back to Nvidia to sell to customers. So for TSMC over here, the problem is it is vulnerable to your geopolitical tensions. So if China were to invade Taiwan, which is unlikely for now because it could lead to a national security issue for the US, especially with the chip monopoly in Taiwan, we could see Nvidia's earnings dropping massively. We could see the whole semiconductor industry dropping massively if China invades Taiwan, which is not something that I am comfortable with. And that is why Warren Buffett sold when he bought TSMC, I think a few years back. He bought TSMC at around $120 and then he sold it in the next quarter because he couldn't bear with this geopolitical risk. Geopolitical risk is very minimal, meaning to say it is very small, but don't discount it out. It could be possible that China could invade Taiwan. Next problem that I have with Nvidia is they are likely inflating their earnings. So as you can see over here, the principal considerations for a determination that performing procedures relating to the valuation of inventories, specifically the provision for excess or obsolete inventories and excess product purchase commitments, is a critical audit matter, are the significant judgment by management when developing provisions for excess or obsolete inventories and excess product commitments. So what they're basically saying is they record earnings that haven't been given to customers yet. So like your Blackwell chips, they're not really given out to customers yet, but they are already collecting money from them and they are basically realizing the earnings already. And so if we come to a stage whereby the Blackwell demand slows and there's no sort of like front-dated earnings anymore, then this could have a massive impact on Nvidia's earnings as well. Last problem that I have with Nvidia is something that is more accounting based. So as you can see over here, Nvidia's revenue grew 18% quarter on quarter in Q1 as compared to Q4. And then if you were to look at their account receivable, it went up around 23%. So accounts receivable went up 23%, revenue only went up 18%. So what this means is that all of Nvidia's customers are trying to push back all their payments. This could be bad for the company if the pushing back of payments becomes too large. And that only leads to sort of like bad debt for Nvidia, which is what I don't like for the company. And this also brings in the fact that they are sort of like front dating their earnings. the argument that I made in the previous one. So let's do a bit of valuation for Nvidia. So Nvidia's current EPS is around 2.94. It is projected to grow about 20% over the next 2 to 3 years. But for this calculator over here is over the next 5 years. So if Nvidia is able to hold a PE of around 30 times, it will give you a CAGR of around 14%, which I think it is very attractive for a company as big as Nvidia. But my problem with Nvidia still stays. If you look at all the different Mac 7 companies, the reason why they are Mac 7 companies and why they can stay up there is because they are consumer based. So because you're consumer based, they are much wider. You can have a monopoly over the consumer, which is much more beneficial compared to a monopoly over B2B businesses. So because Nvidia don't sell to consumers, it is very hard to measure how sustainable their earnings are right now. So imagine 2 years later, if the hyperscalers, they don't need all their data centers already, they don't need to build out all the AI infrastructure anymore, then Nvidia's earnings will likely drop then. And if we have competition whereby all your different chip making companies, they start creating technology that is comparable to Nvidia, then same thing, Nvidia earnings could drop because it is not consumer dependent like all your different other companies like your Google, Amazon, Microsoft. All of these companies, they are very much consumer dependent. They have consumer risk, of course, but consumer risk is much better than having business risk because business risk could be cut easily. Consumer risk is much more wide-based. So for me, I want a very large margin of safety for Nvidia. I want the stock at around $90 to $100. That will be the time that I buy into this stock when the sentiments are absolutely crap. But for now, I still think that this stock is a bit too risky for me. In the semiconductor space, I think you can find a lot more value in your companies like ASML as well as TSMC. TSMC, of course, you have the geopolitical risk. ASML has the IP, it has the monopoly in the EUV space. So I think those two stocks are where you should be looking at in the semiconductor space. As for Nvidia, I don't know how sustainable their moat is. You have competition coming up as well, AMD, all your different hyperscalers coming out with their own chips. No one knows how extensive their moat is. So for now, their moat is here because all these companies, they want Nvidia chips, but I don't know 5 years down the road whether all these companies will still want Nvidia chips.